just a bit of background. Global credit ratings is it's about 20 years old now. We've really made our name by specializing in ratings in Africa, that is applying the best practices from the large international rating agencies to the African experience and understanding those unique challenges within Africa. And that is why we have been involved with many partners over the years in rating municipalities and utilities and various other companies, both in the public and private sector within Africa, and really understanding the unique challenges that Africa presents. And I saw there was one question with regard to benchmarking Dakar. I would say perhaps in global credit ratings, GCR is one of the few agencies that can benchmark Dakar, because we would benchmark Dakar both against a global international city like New York, but also against the various cities we've done in Africa, and see what those differences, and our criteria and methodology that I'll discuss going forward are really based on applying global methodologies within the African context. So I'm going to first start my presentation by going through GCR's rating criteria, and I think it will give you a good overview of how we view the creditworthiness of an entity, and how we build it on different building blocks. So as Jeremy had said previously, that one element in itself will not make the credit rating, but there's various building blocks which we have on the left there. We have four main components, being the operating environment that an entity is in. So that's the country and the sector that you're operating in. Business profile would really refer to the inherent strengths of that entity itself. Financial profile is, well, as I said, that's going through the annual financial statements of the entity to see its financial strength, and then finally just comparing it to other similar entities within that country or within other countries. The truth is that first graph actually within the water utility space would translate into more specifically into these factors. So country risk and sector risk, competitive position. Financial profile, we'll look at the earnings, we'll look at the leverage and cash flow, so the balance sheet of the business, and liquidity, to make sure that a business can meet its requirements over a 12 to 24 month period, which may be very different to the leverage. You could be lowly geared, but if it's all short term and you have no cash flow in the short term, well, that could lead to a credit crisis in itself. So those are the components, and I will go through them in a bit more detail in the following slides. So I think what is unique, and while we look at a water utility as a corporate in a broader sense, as have been brought up in the question, they offer a unique mix of private and public sector characteristics. So on the private side, a water utility does sell a product. It sells a liter of water, and it can put a price on that, and you can buy X amount of liters and you pay X times the amount of liters. And therefore there is a fairly simple business model that can be built around it. And that is why in most countries, water utilities are not privatized, but are corporatized. They tend to operate not as a government department per se, but as its own legal corporate entity, because it has a clear business model. On the other hand, they are almost always, and particularly in developing markets, fully owned by the government, whose whose intention with the water utility is not to make money, but more to provide a critical service. And in most developing countries, that the responsibilities that are provided to the water utility probably far outweigh in many aspects its earnings capacity. So on the one hand, it is a private company. We'd like to see it run as such, and most governments want to see it run as such. But it has an enormous social responsibilities that sometimes do contradict with a profit-making incentive. And balancing both these elements is the difficult job of the boards and the regulators of these entities in each country. And it's also what goes into looking at our credit rating. So we will look at, as you'll see, both that an entity to be the highest rated type of entity, you'd want to see that you're both delivering on your service efficiently and you're making money. One or the other, there's a lot of ratings that go below the best rating bands. And that would be the trade-off through the rating process of water utilities. And it would be equally applicable to other types of public companies like electricity, perhaps telecoms, not as much these days, but various other public service companies. No, I'm sorry. Okay, so we said, I'm not going to go too much into the country and sector risk. Obviously, sector would be water. Country would depend on the financial strength of the country that the water utility operates in, and that would be almost independently determined. Water as a sector is generally a low-risk sector, as I'll discuss later. But let's see, what are the type of things that would give us a good business profile score? So I would say, again, like I touched on it, what you want to see is that the entity can operate efficiency. The number one goal of any water utility is to provide water to the population. And to the extent that it is doing that well, it is extending the water, in a developing market, extending the water service to new parts of the population. Its non-revenue water is low, so that the amount of income forgone is also low. These are all positive aspects. You'd want to see a very favorable regulatory environment, and that doesn't mean no regulation, but that means regulation that works hand in hand with the entity, where tariffs are well planned and take cognizance of the various aspects in the expenditure framework, and where there's a real meaningful, strong working relationship between the regulator and the water utility. So those would be really what we would characterize a very well-performing water utility. Now, generally, as per GCR's criteria, in developing markets, you'd probably only get an intermediate or high classification for most water utilities. And that's because of the infrastructure backlogs that exist because of the historical imbalances, the historical problems that many of these institutions face. Even if they are doing well at the moment, they face enormous challenges. The highest would be really reserved for well-performing water utilities in highly advanced countries, where these water utilities have extremely modern infrastructure. Everybody pays their debts on time, and really their problems are negligible. We know that's not the case in Africa, that there are enormous problems, and even the best performing water utilities will face these problems. But so that is taken into account. So you could get a high score, certainly, and a high classification, but probably not the best. On the other hand, you know, water utilities that, sorry about that. Hang on. Water utilities that are not performing efficiently, or, you know, are just losing money, or their non-revenue water is very high. They can't extend the infrastructure. They can't collect on their debtors. Those would typically be at the bottom end of the credit scale, of indicating weak entities, and therefore their credit quality would almost certainly be quite weak. Okay, again, here there was a few questions about this trade-off of earnings. I said in the business profile, we would actually look at more the operational aspects of the business. Are you fulfilling your mandate? And if you are, that would certainly be credit positive, even if your earnings are not particularly strong or even neutral. Most countries would be quite happy if a water utility could just cover their costs, but provide service to the entire population. They would, however, on the other hand, I mean, it is even more favorable if a water utility could still eke out some profitability from its operations. And again, here realizing that it mustn't be done at the expense of the population. So you want to see tariffs are, again, look at that, are they affordable to the population? What are the increases relative to people's income? Things like that. But whereas for many water utilities, however, the income side is slightly less under their control than is slightly less under control than their expenditure. Expenditure is really where you want to see a water entity coming into its form. And that is because revenue, I mean, it's really dependent on tariffs and dependent on the infrastructure in place. And while that can be expanded, it's going to be a slow process. But are you operating efficiency is how do you control your costs? And therefore that would be a major focus of the credit rating assessment. And there are various metrics that we would use. I'll show you later on in a later slide some of those metrics to determine the cost ratios to see efficiency of the entity. Now, clearly, you'd want to see for the highest rated entities would be where they have good control over their costs while still providing a strong service. Okay, now the balance sheet side of an entity, that's leveraging the capital structure. GCR uses a two-step approach in any entity in determining its leveraging capital structure, and that is to use a set of objective credit ratios, and then to adjust that by various factors which could suggest that the actual credit quality is stronger or weaker than that suggested implied by the ratios. Now water utilities generally are able to absorb a higher level of debt because it's long term. Their demand is fairly inelastic. Their investments are very long term in nature. So it implies that they can have a higher level of debt and therefore weaker credit metrics. However, in saying that, there's no question that when you're doing a credit rating, the less debt you have, the better. And as we'll see, in fact, one of the advantages a lot of African water entity utilities have at the moment is that they don't have debt. That because of historical legislation or other factors that they don't have debt, and this gives them a lot of capacity to borrow to improve their infrastructure. So that's just the slide is just showing you a few typical ratios that GCR would look at to assess the level of gearing. Most importantly, we actually are concerned about, do you generate enough cash flow and earnings to pay your obligations? So we're not really looking at it debt relative to equity, which anyway in a public sector space is a less relevant metric, because equity is probably just is almost always just the national government, and therefore it's manipulated, or it's just set at an arbitrary type of level. But it's, do your operating there, the middle column, operating cash flows, do they cover your gross debt? And are your earnings enough to cover your interest? Now, when we're looking at cash flows, it now becomes very important to make sure that what your earnings and your cash flows are similar. Because what is generally a very negative signal is when you're reporting high earnings, but your cash flows are weak, which essentially means that you're not collecting on your debtors. And I think that is one of the number one challenges of any utility in a developing country, is to collect on their debtors. And therefore GCR always looks quite closely at those debtors metrics, and will make adjustments to our ratios depending on how good debtors management is. What is the ratio of collections there? You know, I mean, other factors that would cause adjustments, I mean, currency risk, because a utility operates in a single jurisdiction, often with a lot of currency volatility, you know, assuming too much foreign currency risk, just because the interest rate may be low, is a recipe for disaster in the long term, we've found. You know, currencies are volatile, and before you know it, that debt is worth a lot more in local currency terms, and yet your income does not change because of currency volatility. You know, funding concentration, and the opposite side of that would be wide access to funding. Wide access to funding is probably the most important positive adjustment factor that GCR will look at. So that we want to see that an entity that is able to raise money from banks, from different banks within that country, perhaps from capital markets or pension funds, if that is available to them in that country, that is a very strong sign of creditworthiness. Not just because each institution will do its own credit assessment of the entity, and you can take some comfort with the fact that numerous financing agencies have provided funding, but because you want to have that flexibility as an organization, that if one bank for whatever reason wants to pull a line or wants you to pay a note or something like that, that you have reserve lines and reserve facilities in place where you could go to. Or if the interest rate is suddenly unfavorable for whatever reason, you have options. Optionality is always critical to making sure that you can service your debts on time. You know, short-term concentrations would obviously be a negative factor. So what you want to see, especially with utilities that have long investment cycles, is a fairly long-term debt profile. Now, again, this in developing countries, this may be limited, that the longest debt you could perhaps get is 5 years in many countries, unless you're getting it from development agencies, in which case it may be 10 or 15 or even 20 years. But even if it is 5 years, then you want to see that an entity is able to manage their debt in such a way that each year around 20% of the debt matures, and therefore the refinancing requirements in any given year are not too onerous. Oops. And finally, I said that besides just looking at the capital profile, you want to make sure that there is enough liquidity for an entity. It's no use having just a little bit of debt, but having it all in the short term, whereas you're building a 10-year payback project. That, because when those loans come up within the 12-month period, you're not going to have the cash flow available to repay. And in fact, this is what causes a lot of the credit events for utilities. Is not that they don't have the long-term balance sheet strength or shareholder support from the government, but it's because they can't pay their loan that's due next week, and approaching the government will take time because it needs to get various approvals and cash flows. You're not collecting fully on your receivables, and any other funding source will also take time. You just don't have that available liquidity. It's a critical pitfall for many water utilities and utility companies in general. So therefore, in assessing liquidity, GCL will always look at what are your immediately available source of liquidity. Obviously, cash being the most immediately available and readily available of those things. But then also, what are the committed funding lines? You want to see that there are committed funding lines in place that could be drawn down on short notice, or that there are various perhaps grants in place that could be given on short notice. But here we're talking about really that short notice versus what are your short-term obligations. So how much debt is maturing in the next 12 months, in the next 24 months? What CapEx commitments you have that can't be reneged on or scaled back in need in the next, over that 12 to 24 months period, and any other cash flows that you may need. So if you are retrenching workers, and that will need to be paid, that may have to be included in liquidity. You need to make sure you've got resources available to pay some of those back. So that becomes critically important. But finally, in assessing our water utilities, you do need to look at government support, because as we said before, water utilities not only are there to operate profitably, but they're also there, but they're mainly there to provide a social service. And therefore, governments, whether in developed countries or developing countries, do support their utilities and can't afford to let them fail, because you can't have a situation where a major city does not get water because the entities failed. So an element of government support will always be factored into a utilities rating. Now, sometimes that support could be explicit through guarantees, where and that would be easy to then assess, in which case the utility will probably have a credit rating that is very similar to the government's credit rating. But where there's no guarantees in place and the utilities rating may still be strong, but it will be different to the government, right? You could still factor in implicit support, and therefore you're really looking at what is the likelihood that if this utility runs into problems, the government will provide it with either funding support or technical support or regulatory leeway or things like that will carry it through a period of difficulty. And to the extent that support is provided, the rating, even for a weak entity, can be uplifted. And to be honest, in almost all ratings that we've done in Africa, that government support is available, because the government often pays for the capex, does offer guarantees for some of the debt, has some favorable legislative agreement with entities or that type of thing. So it becomes an important factor. Okay, I'm going to come back to this slide and that one. I think it's better to go into the credit rating comparison. So, like Jerry alluded to, there was a Kenya pooled water fund, and as part of this project, GCR rated or provided at least credit assessments for a number of the entities that were to be combined into this funding vehicle. So I thought it was useful to look. So while it is a bit confidential, I haven't given the names of exactly the entities. Here are some of the metrics that came out from our assessment. Now, actually going to the bottom as a starting point, it's interesting to look at what was the difference between the water service provider 2, which got an BBB rating, BBB+ A rating, compared to water service provider 5, which got the lower end BBB rating. And I would have to say there, when I look at that, its operating metrics are much better, water service provider 2. Its coverage of the population is higher, although both are quite good. Its non-revenue water is lower. And then when you go to the financials are also stronger. So the EBITDA, the operating margin is much better, and that was because there was a lot of non-cash expenditure and all sorts of strange financials in the water service five financials, which were cause for concern. Look at the trade debtors to revenue. There is completely different. Whereas water service provider 5 had very poor collections, 103% debtors were more than revenues. Net debtors, it was the lowest for water service provider 2. Both didn't have any debt, so that was a strength for both. But water service provider 2's cash flows were better in every year, and that, I suppose, is a factor also of the fact that your collections are better. So it just shows you some of the differences. Another important thing actually that GCR looks at, and I think this is critical, is the corporate governance. And for public entities, it really comes a lot from the Auditor General or the similar agencies reporting that they do. And you want to see a reasonable standard of accounts. Now, it's often not apparent, but you still want to, in developing markets. But there's no question that we put a lot of weight on what are the qualifications that the Auditor General picks up, and the seriousness of them. And utilities or municipalities or anything that have unqualified reports, or at best clean reports, which is very rare, would generally be rated much higher, because you can put a lot more faith into their financial statements and into the fact that they are fulfilling their mandates. But as you can see in these Kenyan ones, most of the ratings, while getting into the investment grade bands, were at the lower end, BBB-, BBBs, going up a little bit from there, but that was basically the band. However, we saw, and Jeremy brought this up, the next example I'd like to bring, National Water and Sewage Company Uganda, is we've seen there, GCR rated that about 10 years ago nearly, and 10 years later rated it again. And there you saw a fundamentally different organization. They had improved in leaps and bounds. Like I said, water connections had gone up by 40%, so therefore that expanded their coverage significantly. The amount of water they produced and sold was up 50%. Non-revenue water was down from 60 to 40 to 31. And that obviously flowed into all much, much stronger financial figures than had been in the previous thing. And therefore, the rating of that entity, I think, went from an A to a double A. And it really shows you how strong management, how taking a earlier credit rating report was part of a much larger assignment, and implementing the findings and of various other organizations, not necessarily it was only the credit rating report, but could bring them to a position where I think National Water, NWSC is about to issue bonds to, I mean, I'm not sure, to various pension funds that in Uganda because of their strong operating and financial profile.
Hi, Eyal. I think that's a great slide or a great point to end on. If there's one thing that you'd like to give as a closeout, I'd like to hand over back to Jeremy to finish us off and leave time for questions and answers.